The S&P 500 came within 0.5% of making all-time highs last week. But could that actually be a bearish signal? Keep watching to find out why this next week could be so crucial for the market going forward.
The U.S. markets were relatively unchanged last week, with the Russell 2000 leading the way, up about 0.8%. The Russell's still up about 10% for the year. The Dow Jones was down about 0.6 for the week, up 2.4 for the year still, and the S&P down about 0.25% last week. Foreign stocks and emerging market stocks both got hit again last week, with emerging markets down around 1% and foreign market stocks down 1.5%. Both these indexes, foreign and emerging, down 2.6 and 6.5 respectively. The chart that we're looking at today is of the S&P 500. Matt mentioned in the introduction that we came within 0.5% of breaking the all-time highs for the S&P 500, but ultimately, at the end of last week, ended up about 1.5% away from that all-time high. So why exactly is this a bearish signal? The chart pattern that could be forming here is called a double top. And a double top chart pattern happens when failure happens at a resistance level twice in a short period of time. This is usually a bearish signal for the markets. As you can see on the chart, the top line is a resistance level that was put in at the beginning of the year when that all-time high on the S&P 500 happened at 2875. If we don't continue up and break through that resistance level, we could see this chart pattern confirmed and could potentially see a move back down to the blue line, which is the uptrend support line at 2675. And that's about 5.5% away from where the S&P 500 is right now. If the S&P 500 breaks down below this support line, we could potentially see a move down to 2550, which is the long-term support line, and that's about 10% away from where the S&P 500 currently is, and that's a level that hit twice this year before the rebounds happened. So the level that we're looking at here is, again, a very important level, because if we don't break above this resistance level and make new all-time highs on the S&P 500, we could potentially see a move down 5%, even 10% or more over the coming weeks and months.
Last week's news began with President Trump putting more sanctions on Iran and also warning anybody that's doing business with Iran could possibly be seeing sanctions as well. But the big news came that he's going to be looking at adding back the Iranian oil sanctions in November. We're continuing to see increased volatility from the emerging markets because of the Turkish currency crisis. And President Erdogan has come out this past week and said that he is not going to raise interest rates to try to help prop up its currency. So the increased volatility is probably here to stay until this is fixed. Earnings season has been a great success for the S&P 500 companies. But what's being overlooked is that companies are raising their fourth quarter guidance by approximately 0.6%. which means that companies are giving a better outlook than what was expected for the end of the year. And it's going to be interesting to see if companies are going to be able to deliver on those high expectations with the increase in tariffs and trade wars. We've seen 90% of the S&P 500 report their second quarter earnings, and we've seen record revenue growth, along with 79% of these companies beating their expectations.
Even with all the good news from earnings, we haven't seen the S&P 500 break out above the all-time high that was put in earlier this year. And we're going to need that to happen to remain bullish on the market moving forward.
Thanks for watching, and we strive to give you everything that you need to know about the markets in 5 minutes or less.
Like our Facebook page and share our video. Thanks a lot.